Welcome to Invest Education Hub, the place where we simplify investing and show how small steps can turn into long-term success. Today, we're not talking about vague what-ifs. Instead, we're showing you exactly how a consistent investor would have grown their money since 2019 using one of Fidelity's most popular index funds, FXAIX, which tracks the S&P 500. We're going to see the real numbers, the real highs, and the very real lows.
So, here's the big question we're tackling today. What really happens if you just stick with it? If you invested consistently every single month for the last 6 years, through all the crazy ups and downs we've seen, the pandemic crash, the inflation fears, the massive rebounds, what would that journey actually look like for your money? Well, today we're going to pull back the curtain and find out. All right, let's get into the setup. To make this real, we're going to follow a hypothetical investor, but their plan is super simple and totally realistic, something anyone could have done. So let's lay out the ground rules for our little experiment.
Okay, so picture this. It's January 2019. Our investor is ready to go. They kick things off with a one-time $1,000 investment. That's the starting line. That's the seed capital for this entire journey we're about to watch unfold. Now, on top of that first grand, they commit to something really simple. Just $150 every single month. That's it. It's not a life-changing amount of money, right? But the secret sauce here is the consistency. Rain or shine, good market or bad, that $150 is going in. And as we'll see, they actually bump this amount up a little each year, which is a fantastic habit to get into.
So, where's all this cash going? Great question. It's all going into one single investment, the Fidelity 500 Index Fund. Its ticker is FXAIX. You've probably heard of it. It's one of the most popular funds out there, and for a good reason. It just tracks the S&P 500. Think of the S&P 500 as a big basket holding 500 of the biggest, most successful companies in the US. So by buying into FXAIX, our investor is basically getting a tiny slice of the entire American economy. Simple, diversified, and, as we'll see, super effective.
All right, the plan is set. The money is ready. Let's hit the play button and see what happens. And wow, our investor could not have picked a better time to start. Seriously. 2019 was an absolutely incredible, blockbuster year for the stock market. Let's crunch the numbers for year one. So, they started with that initial $1,000, right? Then they added $150 a month for 12 months. That's another $1,800. So all in, they've put $2,800 of their own money into the market. And the market just took off. The fund returned a whopping 31.48%. So by the end of the year, that $2,800 had ballooned to almost $3,700. That's nearly $900 in pure profit just in the first year. What a start, right? You'd be feeling like a genius. Okay, after that amazing first year, we roll into 2020 and 2021. And, well, you remember what happened. These were some of the wildest, most unpredictable years we've seen in a long, long time. We had that massive, sudden market crash at the beginning of 2020. Total uncertainty. But here's the key. Our investor, they didn't blink. They stuck to the plan. And that decision to stay consistent right through the middle of the chaos, oh man, it paid off big time. Check this out. This is where it gets really interesting. In 2020, even with the world turning upside down, they kept investing. They even bumped up their monthly contribution to $200. And look at the result. The market came roaring back from the crash, ending the year with an 18% gain, and their balance shot up to $7,200. It nearly doubled. Then, in 2021, the good times just kept rolling. They increased their contribution again, this time to $250 a month, and the market gave them another huge return of almost 29%. Their portfolio almost doubled again. We're talking over $13,000 by the end of 2021. You can literally see the compounding effect starting to take off. It's like a snowball rolling downhill, picking up speed and size. Okay, so after 3 straight years of just incredible returns, it feels like this is easy, right? You just put money in and it grows. Well, then comes 2022. And let me tell you, this is the year that separates the dabblers from the dedicated long-term investors. This is the big test. The plot twist in our story, it's the painful reminder that stocks don't always go up, and this is where your emotions can really, really get the best of you. Yeah, after that amazing run, the market just slammed into a brick wall. We had soaring inflation, a lot of geopolitical uncertainty, and boom. The S&P 500 and our FXAIX fund right along with it finished the year down a painful 18.14%. Just think about that for a second. For the very first time, our investor opens their statement and sees a big, fat, red negative number. That is a gut punch, no matter who you are. And this slide right here perfectly captures why 2022 was so emotionally tough. Our investor, remember, is sticking to the plan. They upped their contribution to $300 a month. So over the year, they put in another $3,600 of their hard-earned money. And what happened? At the end of the year, their balance was only about $13,700. Let that sink in. They put in $3,600, and their account balance only went up by about $600 from the previous year. It feels like you're literally shoveling money into a furnace. This is the exact moment where the panic sets in for so many people, and they hit the sell button, thinking they need to stop the bleeding. But our investor, they don't sell. They grit their teeth, they trust the process, and they stick to the plan. And you know what? This is it. This is the defining moment. This point of maximum pain and frustration is the dividing line between people who build real wealth in the market and those who don't. Because our investor understands a crucial secret. When the market is down, everything's on sale. Every $300 they're putting in is buying more shares of the fund than it did the year before. They know that the real explosive growth, it almost always happens right after the storm passes. And because they were brave enough to keep buying all through the downturn of 2022, they were perfectly positioned for what came next. That pain, that discipline, that patience, it was about to be rewarded. And I mean in a huge way. And here is the reward. Bam! 2023 happens, and the market comes screaming back with a 26.29% return. And because our investor was buying up all those discounted shares in 2022, their portfolio didn't just get back to even. It took off like a rocket, soaring past $22,000. Then it gets even better. 2024 keeps the party going with another amazing 25% return, pushing the total over $34,000. All that discipline, all that sticking to the plan through the tough times, this is the beautiful payoff. This chart just says it all, doesn't it? Let's zoom out and look at the whole picture up to this point. By the end of 2024, our investor has put in a total of $19,800 out of their own pocket, but that money is now worth over $34,000. That huge gap between the blue bar and the green bar, that is the magic of compounding and consistency. That's the growth. That's the reward. So there you have it. We've just walked through 6 absolutely wild years in the market. We saw a fantastic beginning, a brutal test of will, and then an even more incredible comeback story. Now let's wrap it all up and take a quick peek into the future to see where this is all heading. Okay, let's fast forward just one more year to the end of 2025. Let's say our investor is now putting in $450 a month, and the market gives us a pretty average conservative return of about 8% for the year. Well, their portfolio could cruise past $42,500. Now think about that. At that point, they will have put in about $25,000 of their own money over the years. That means over $17,000 is pure, unadulterated growth. Their money has officially made more money for them. And when you see the entire journey laid out on a timeline like this, it really changes your perspective, doesn't it? You see the strong start, the crazy volatility of 2020, and then there it is, 2022, the big test. But from way back here, with the benefit of hindsight, it doesn't look like a disaster at all. It just looks like a tiny little speed bump, a temporary dip on what is clearly a long, powerful upward climb. So what is the secret force behind all of this? What's the engine driving this whole thing? It's a little thing called compound growth. You've heard it called the 8th wonder of the world, and for good reason. It's simply the idea that the money your investments make starts making its own money. It's a slow burn at first. You barely even notice it. But over time, that snowball effect kicks in, and it becomes this unstoppable force that does all the heavy lifting for you. And that really brings us to the single biggest lesson from this whole case study. Our investor wasn't some Wall Street wizard. They didn't have a crystal ball. They didn't perfectly predict the 2020 crash or the 2023 rebound. They couldn't have. Their success came down to one simple, powerful mantra. It's about time in the market, not timing the market. They just stayed in the game, and that's what mattered. Okay, so we've spent all this time looking backwards, right? We've been analyzing this incredible journey that kicked off way back in 2019. But the real lesson here, the most important part of this whole explainer, isn't actually about the past. It's about your future. It's about what you choose to do starting right now. So let's just leave it with this final thought. We've proven, with real numbers, that a simple, consistent plan started in 2019 could have turned into more than $42,000 today. But here's the thing. None of us have a time machine. We can't go back to 2019. So the only question that really truly matters is the one you see right here. What happens if you start now? Just imagine, 5 or 6 years from now, you could be the one looking back at your own journey, totally amazed at where those small, consistent steps have taken you. Of course, please remember that this explainer is for educational purposes only and isn't financial advice. You should always do your own research and maybe even chat with a financial professional to figure out what's best for you. Thanks so much for joining us here at Invest Education Hub.